Good afternoon, everyone, and welcome back to the NWR Virtual Investor Conference Series 11. I'm your host, Banjo Blake, and next up is Centrepoint Alliance, ASX code CAF. Centrepoint Alliance is a leading provider of advice and business services to financial advice firms throughout Australia. It offers a complete suite of governance, business management, client growth, and advice services that enables advisors to spend more time producing advice to their clients. Presenting this afternoon for Centrepoint Alliance is their CEO, John Shuttleworth. Without further ado, I'd love to hand over to you. Thanks, John, and welcome to the conference.
Yeah, thanks very much, Banjo, and thanks everyone for your interest in Centrepoint. Hopefully over the next 15 minutes, I'll provide a snapshot of our business and give you a good feel for what exactly we do, how we've been performing, but importantly, strategically, where we're heading. By way of background, I joined Centrepoint in August last year. Prior to that, the most probably relevant experience was I was 15 years at BT Financial Group as a general manager there and ran various things, but for a large portion of it ran all the platforms and investments business. And I joined Centrepoint because I think the business is in a really interesting phase with some of the changes that are going on in the market, and I'll give you a bit of a flavour for that. So let's kick off and get underway. Firstly, I thought it would be useful just to explain a little bit about our business so you can understand what we are. And we really are a diversified financial services company with a core strength in what I'd describe as licensee solutions. So effectively what we do is we provide everything you need to run an advice practice. So all of the research, the compliance, the training, we provide the advice technology, anything an advisor needs to effectively run their business. And the way our model works is we have 525 advisors that operate under our license. So we have the AFSL and their corporate authorised reps. We have around 185 small AFSLs that operate under their own license, self-licensed advice firms. And they've got around 700 advisors attached to those 185 firms. And we have a small salaried financial planning business as well. So the licensee solutions part is the biggest part of our business. We also have a lending solutions business, which is everything you need to run a mortgage broker. So we're a boutique provider of lending services. We've got about 80 brokers in the network, a $3 billion loan book, and we have a panel of 60 lenders. And I'm going to use this one as a case study because it's a little different to the standard licensee business, and it'll give you a good feel of some of the opportunities for growth. On the investment management side, that's the third pillar. We have a managed funds and managed portfolio business. It's called Ventura. It's got a 20-year history. There's around $730 million in funds under management, 400 of which is in managed accounts, separately managed account structures. And finally, the fourth component is technology solutions, which is the core focus. And this is a real area that we're trying to build up. What are the core underlying technologies you need to improve the efficiency of advice? So about 18 months ago, the business bought a professional services company called Inzumo, which does effectively helps people configure advisor software into their practices. And increasingly, we're bringing together best of breed technologies to help advisors produce the most efficient advice that they can. So they're the four main lines of business. The snapshot of our earnings, and this is up until December, and I should say here, when you're looking at this data, I'm going to go into it on the next slide. There's only 2 months of the Clearview advice acquisition. We bought Clearview's financial advice business, and I'll go into that detail. So some of these numbers have got 2 months of data, but it'll start giving you a bit of a feel. So gross revenue of 95.5 million. The EBITDA is 2.5 million, which was 14% up. We have around $12 million in cash. This is as of the 31st of December, and paid $0.005 dividend. It's been solid financial performance. I'll talk you through this acquisition that we think was transformational. We've managed to drive out some good cost synergies. The licensee, as of the end of January, had grown to number 3 in the market, and I'll share with you some data on that. And our recurring revenue has increased to 96%, up from 87%. We've had some challenges with the investment margins being down due to legacy fund outflows and rising fund costs, and we're in the process of turning that business around, and I'll give you a feel for that. And as I mentioned before, the transaction that we completed, which we announced in August last year and was completed when the shareholders approved it at the AGM on the 1st of November, was the acquisition of the Clearview advice business. Now, to give you a bit of a feel for the business, so Centrepoint Alliance, we obviously had a fairly significant presence in the market, and Clearview made a decision to divest their advice business, and we worked very closely with them and have successfully integrated that business. To give you a feel, we had 315 advisors, and post-acquisition, it went to 511. The reason there's a little bit of difference between the numbers, some of these are internal versus external numbers that are reported via ASIC versus our own internal data, but directionally they're very close. The number of self-licensed practices grew from 151 to 185. Headcount only marginally increased, so you can get a feel for the synergies that we'll be driving out of this business as the year goes on, from 99 to 105, and cost to income ratio has started to improve, and gross profit has also started to improve. We implemented a new organisational structure from day one, strengthened the leadership team, and got some very good executives coming across from the Clearview business. We've had excellent advisor retention, and in fact, when we look at any losses, I can say that I can't think of any that we've had due to the acquisition, and in fact, many of the advisors that have come across were very happy to be part of Centrepoint because Clearview was a life insurance company, and being an independent advice business just gave them that independence. What I wanted to do was just switch gear a little bit and just talk a little bit about the industry we operate in. And the need for advice has never been greater. When you think about our market, there's $13.4 trillion in household assets, and the split of that is there's $3.4 trillion in super. People have around $9 trillion in land and dwellings, just under $3 trillion in investments, and there is a large amount of money that is going through an intergenerational wealth transfer. What's driving the need for advice is there's a great shift from accumulation to retirement, driven by the ageing population. There is a lot of complexity as a result of the interplay, and it is the interplay. It's not each underlying thing by itself, but the interplay of superannuation, retirement tax, and social security. So it's hard to retire without some degree of advice. We have reduced accessibility to financial advisors. There's more demand and less advisors. If you look at the ASIC data, the number of advisors has been reducing post the Royal Commission and the FACIA requirements. And we've also got the issue of Australians living longer and the risk of outliving their retirement savings. So we're operating in an industry that is highly attractive. The other piece is that whilst we, at this point in time, only derive our fees mainly from the licensee fees we charge advisors, the market we operate in is large and attractive, and there's good opportunities to expand into other areas. Based on our estimates, we think there's around $5 billion in advice fees charged, and that's simply by multiplying the number of advisors times the number of clients and average fees. There's $4 trillion in managed funds, around $1 trillion in platforms. You can read the rest of the numbers, but the market is absolutely large and attractive. When you think about our business and our underlying strategy, the best way to think about it is we have three core pillars for growth. The first area that I've sort of outlined is the licensee and lending solutions. And that's really about growing scale and expanding the depth of services. We continue to focus on recruitment of the licensed advisors, recruiting self-licensed firms, and building out the salaried network. And that, as I mentioned, is our core business. I'm going to go into a case study, but we also have a business, a lending business that is, we describe it as boutique, which effectively means it's small and has large potential. And that's an area of real focus at the moment. On the investment side, we are in the process of pivoting from managed funds to managed accounts. We have some managed funds that we're in the process of divesting to one of the underlying managers, And the whole focus of the business is going to be producing managed portfolios. We run it today, Ventura managed account portfolios, and we're building some external SMAs that we're going to put on the market. We're also making some significant inroads into financial services tech. We're not going to set ourselves up as development, but our whole strategy is to source and integrate the best cloud-based technology providers to deliver the best digital advice capability. And the key thematics that we're focused on is advice tech, which is around the advice process, the regulatory tech to use underlying technology to improve the monitoring and compliance, and then the whole digital advice. How do we use digital processes with digital needs capture and advice to improve the efficiency of advice businesses? Obviously, in each of those areas, we continue to look at the market for acquisitions, and if we find another business that we can acquire, we will, and it makes sense and earnings accretive, we'll look to acquire some of those capabilities. In terms of how we are performing, this was the chart at the end of January, and the data pulls data reported by a company, Wealth Data, that gets all the information from the ASIC Financial Services Register. So you can see that Insignia were number one in AMP, but had significant outflows of financial advisors. Centrepoint at 525, and we posted net 27, and you can see the rest of the industry. So we were very proud that in addition to doing the acquisition, we were the only firm in the top 10 that had actually shown net advisor growth, as well as completing an acquisition. Now, subsequent to this chart being produced, there was a recent merger of Wealth Today and Synchron. So they have increased in terms of size. They're now number 3 in the market. So we'd be number 4 post that acquisition when we update this data. I wanted to just quickly, in the short time we have, provide a little bit of an overview of lending as a service, because it shows and is a good example to illustrate some of the diversification that we have, or the potential within our business. So as many of you would be aware, the lending market is attractive, and there's a natural synergy with providing advice and also ensuring people have the most competitive home loans. The residential market is around 480 billion. If you look at the average of 60 basis point margins and then the trailing margin, we estimate it's around a $3 billion revenue pool, and brokers write around 300 billion of that. Commercial, 420 billion, a slightly lower revenue pool, 2 to 3 billion, and brokers are writing 168. The market's made up and split between 60% of businesses written through brokers and 40% bank direct. And there's a range of aggregators. There's about 16,000 brokers who are effectively work through a variety of different aggregators, the big ones being AFG, Connective, Loan Market. If you look at this as an opportunity, obviously a 1% penetration of the market. If you look at Resi, it's around 5 billion, and it's a $30 million revenue line, which is substantial, and the commercial numbers are there. Now, our Centrepoint business, we have all the infrastructure, distribution and capabilities to grow this business. So we're a boutique provider. We have a credit license. We've got lending infrastructure. We've got our cloud-based technology, which includes the CRM system and the lending system. We have a lending panel with 60 lenders. We provide all the compliance, audits, training, and build a sense of community. As mentioned before, we're small, $3 billion loan book, 80 brokers in the network, but we've had strong growth, 48% increase in prior comparative period, and EBITDA 750K, so we're profitable. When you look at our network and you take the number of advisors, you look at home ownership, you estimate the average loan. We estimate that within our network of financial advisors, there's probably around $54 billion in loans. We know that around 20% are refinanced each year. And so if you work through the numbers, we think there's a revenue pool of around 65 million upfront and 16 million recurring. So our strategy in the lending business is going to be to enable advisors to participate in lending. We're launching what we're referring to as lending as a service, which is really providing all the enabling infrastructure, allowing advisors to work as authorised reps under our licence, and and basically build a lending business by partnering with Centrepoint. The second priority that we're having a look at is, because we have what a lot of startups don't have, we have all the underlying infrastructure. It wouldn't take much for us to put a web front end and enter the B2C space or the B2B and provide a digital lending business. So we're in the process. Initially, our first priority is to expand the distribution of lending through advisors, and then we're going to be looking at, can we leverage some of the underlying infrastructure to build a B2C fintech play in the market. So that just gives you a little snapshot of two areas we don't often speak about. The way I'd like people to think about our business is, we're a profitable financial services company. The Clearview acquisition has created a financially stable business, and if you look at a lot of licensees, where there's not many that are profitable. We've got a core strength in our licensee services. We're absolutely focused on growth. We're going to continue to try to scale the licensee business. We're trying to invest in new capabilities, the lending and the separately managed accounts within the asset management space. Continue to focus on technology, and if acquisitions come along and we're actively looking at the market, then we'll participate in those. So that was a very quick overview of Centrepoint Alliance, and with that, I think I'm hopefully right on time and we can go to questions. So I'll hand over to Banjo to see if there's any questions.
Perfect. Thanks a lot for that presentation. It was great to get a bit of an insight into Centrepoint and its Clearview Advice acquisition. Speaking about the Clearview Advice acquisition, how has the acquisition integration gone versus expectations? Have you found that more expense synergies than expected? And on the revenue side, is there an element of cross-sell opportunity?
Look, the acquisition has gone very well. When we announced the acquisition on 1 November, well, actually, let me take a step back. We announced that we were going to acquire the business in August, and we then spent the next 3 months working through the organisational structure and the operating model. So when the shareholders actually approved the acquisition, we had the new organisational structure in place with all the key executives. So what we've been able to do is, from day one, when we took ownership, we were able to drive out the expense synergies. It wasn't as if we brought the whole business together and then took 3 or 4 months trying to release the expense synergies. It was all done at day one. We've managed to retain some really good talent from both sides. So I think we've strengthened the business. We've retained advisors, and we've been able to get net advisor growth. So, for all intents and purposes, it's gone really well. There's some capability that we got when we acquired the Centrepoint business. They had a good offer for self-licensed advisors that was branded La Vista, which is the way they've packaged up their self-licensed business. We've now selected that La Vista brand. The gentleman that was running that is now running that, because we had our historical AAP self-licensed business, and we've combined that and relaunched that. So we've picked up that. The other thing that Clearview had, which has been really beneficial, they'd invested in some reg tech advice solutions to do automatic monitoring of compliance, and we've obviously implemented that across our business as well. So what we've found is that it's been, we think, a very successful acquisition through the retention and how we've managed to bring the businesses together.
How does the competitive landscape look now after a period of some consolidation? Will your M&A strategy now focus on technology rather than buying advisor groups?
Yeah, look, we're still looking around at advice groups. Look, I think the challenge is there's a small number of advice groups that you would be interested in, and some of the recently announced acquisitions, they were businesses that we didn't have on our shortlist. Where our focus is very much, if we're going to get a business, you've got to get businesses that are culturally aligned. You've got businesses that have similar kind of fee structures, but there's still an opportunity for further consolidation around the mid-tier license space. There's been huge outflows from the IOOFs and the AMPs. Over the last couple of months, that has slowed, but we still have a really large pipeline across the licensed and self-licensed business of prospects that are going through various stages of onboarding. So we think that business, there's clearly real synergies because we've got the infrastructure in place, and if we found another business that we could bring across, the key is you don't want to just grow for the sake of growth. We're a service-based business. We've got to excel on service, and you don't want to bring on so many advisors that you can't service them. So we have to have sensible and controlled growth to ensure that we can provide better services. We are looking at other areas, whether it's acquisition or it's an investment or partnership in some of these other areas. I think what's changed in the market over the years, and I've done a lot of technology development when I was at BT, there was a time that you had to invest and build a lot of the tech bespoke, and you'd have a long lead time. There's so much cloud-based technology around today that you can configure new business models by renting rather than building technology and producing a unified interface to deliver the solution that you want. So we're very much focused on, whilst we're looking at opportunities, we are certainly not interested in paying ridiculous multiples when we can partner and deliver some of the capability through other means.
Perfect. Thanks a lot. Unfortunately, that's all the time we have for today. Appreciate your time, John, and all the best with Alliance.
Yeah, thanks for your interest, everyone on the call. And if you need anything else, let me know.
Terrific. Awesome. Thanks a lot. Cheers.
Yeah, bye.